welcome back, and thank you for joining us for today's last session of our Seattle 22 conference. It's so great to see so many of you in person, so thank you all for coming out. My name is Christine Patton. I work with PwC in our Medicare reimbursement group. So a couple shout-outs before we get started. Thank you to our sponsors. Without you, it would be really hard for us to make these educational opportunities possible. So we really appreciate you. Make sure everyone to visit sponsor tables out there and show your appreciation as it means a lot to our chapter. This session is worth 1 CPE credit. If you're here in person, just make sure to check in at the back corner, right where Mike Smith over there is coming in. And then if you're on the virtual audience, please make sure to fill out a survey at the end of the completion of this session so that you are able to receive credit. Also, if you are attending virtually, we ask you ask questions in the Zoom chat box. We'll be monitoring that throughout the session, and then we'll go ahead and broadcast your questions to the presenters at the end of this session. So now I'd like to introduce our speakers. We have Sarah Buhl, who's a senior manager at Moss Adams. She's practiced public accounting since 2014. She provides tax solutions to healthcare organizations, and her technical experience includes corporate transactions, ASC 740, and tax exempt. Melaney Scott is a senior manager at Moss Adams. Melaney has provided compliance, regulatory, and internal audit services since 2007, as well as accounting and finance work since 1999. And we have Matt Stopa, a senior manager at Moss Adams, and he has practiced public accounting since 2010. He provides audit review and attest services to many great clients. Excuse me, Matt. Companies in a variety of industries, including healthcare, benefit plans, and not-for-profit. Sarah, Melaney, and Matt, it is all yours. Take it away, and thank you.
Thanks, Christine. Well, good afternoon, everyone. It's wonderful to see you all and have a chance to share some information. So today we're going to talk about CARES Act, where are we at now, and primarily be focusing on provider relief funds, but we'll touch on a couple other things in the beginning. For today, our agenda, so we are going to talk a little CARES Act funding refresher. We'll also discuss PRF reporting and funding updates and some considerations. Matt's going to go through accounting and auditing updates and considerations, and Sarah's going to finalize us with some tax updates and considerations as well. So before we jump in, just a couple words of caution. So the information we have today is really based upon its current as of today. What we've seen, things can change, especially if we're talking HRSA and the provider relief funds. So information we have available as of this morning. And thinking about deadlines, keep those in mind, really encourage to keep those on the radar and have some tracking mechanisms for those. Thinking about communication, oftentimes in some of the things we'll discuss today, communication channels within your organization can be super helpful because really there's compliance aspects and there's some other pieces. So just think about building out some of that along the way. And also monitoring HHS, HRSA guidance that they release as well. And then we can't say this enough, and we all know this, documentation, documentation, documentation. So super important, and we'll discuss that throughout as well. Okay, so some of the common funding streams that we consider under the CARES Act, of course, near and dear to my heart is provider relief funds. And as we know, there was the 3 phases that had fully been paid out and various targeted distributions as well. And then we've also more recently have the phase 4 and the ARP rule. So even as of today, we'll see here on a slide, folks are still getting some of the phase 4 payouts as well. There's also been the opportunity for the HRSA uninsured and underinsured programs for the testing and vaccinations. And then there's also the SBA Paycheck Protection Program, commonly referred to as the PPP. There's also FEMA opportunities available for folks. And then one other one that's emerging and folks are partaking of is really the Employee Retention Tax Credit. So just a real quick recap. I know it was painful for a lot of us going through the period 1 reporting. And again, that deadline was November 30th. It had been extended. HRSA says if for some reason an entity did not report by that November 30th deadline, then those funds would need to be returned. And also, if there was any unutilized funds that had occurred, that would be another situation for returning the funds. And I would say there's a third one that had come up for some folks, and it was around phase 3 funds that had been received. When they went through and recalculated, some folks discovered they felt they had been overpaid, and that HRSA had provided updated guidance that if you feel like you've been overpaid, you would need to return those funds. This could be coming on phase 4 as well if folks are taking a look at it. HRSA has said if for some reason an entity doesn't report, then that will affect future PRF distributions as well. Now, thinking about our phase 4 and the ARP rule, like we mentioned, back in December, folks started to receive phase 4 funding, and it's continuing as well. Just a couple of weeks ago, some folks were receiving some of the phase 4 funds. Shaking your head, did you get them recently? Yeah. The ARP rule as well, those distributions began in November. As we know, with a lot of the funding streams, they weren't necessarily always well marked when the deposit occurred or other communications. So what we often would do is just track and target by those dates when things might have been received to go back and look to identify a payment that you might have received. Wanted to call out, thinking specifically about the phase 4 and the ARP rule, as we know, every funding distribution has had their own set of terms and conditions documents, and for the most part, there was common language within those, albeit some of the targeted distribution, most specifically the nursing home infection control, did have specific uses that those funds could be, but wanted to call out here a couple of bullet points that were new elements found in the phase 4 terms and conditions document. And one of which is the mergers and acquisition bullet point. And as we know, there's been FAQs and other information, and it's in some of our other guidance documents about needing to notify HRSA if there was a merger or an acquisition. And now HRSA has put this right within their terms and conditions document. So super important to keep that in mind if your entity has had one or might be on the verge of a merger or acquisition, to really keep this in mind. The other new bullet point is specifically around keeping the funds in an interest-bearing account. We know from period 1 reporting that interest needed to be calculated and reported, and now there's a specific CFR reference, the Code of Federal Regulation, that for folks to look at. There's some exceptions to this, so it would be a good idea if you did receive the phase 4 funds to take a look at the CFR and contemplate if this would apply to you or if you meet one of those exceptions. On the ARP rule, again, there was some new bullet points as well we wanted to call out for folks. The first one has to do with this certification that if you receive the ARP rule, that you do indeed meet the eligibility requirements for it. And as we recall, on the application for phase 4, there was a little box to check that says, yes, please consider me for ARP rule. And HRSA had said, don't worry, we're going to do the checking, and we'll make sure that you meet those requirements. Well, now we've got this bullet point that in essence is saying that you are certifying that you do indeed meet those requirements if you receive the ARP rule. So really would encourage you to take a look and validate for yourselves that you do meet those requirements and kind of watch that and make sure that stays into play. We also have this bullet point that you're going to certify that the monies received will stay on that TIN or the billing TIN. And so this is an interesting bullet point because from prior distributions, this really falls squarely within a targeted distribution. HRSA had said that it's okay, you can use your targeted distribution throughout your organization. I would really look at this language and contemplate it if you did get the ARP rule. This is different than we've normally had, so really important to consider the implications and how you might need to track those funds for reporting and the expenses or expenditures you would apply. It does have the same merger language in the phase 4 that we talked about. And there's the interest bullet point as well, but it's an expanded CFR reference. And I've been watching, and HRSA so far has not provided clarified language as to why the difference. But again, would encourage you to take a look at this full CFR reference as well just to see if it applies to you, because some folks for period 1 reporting didn't necessarily keep funds in an interest-bearing account, so it would be important to know if that's going to be an implication for you. This here is, just wanted to call this out. This has been in every single terms and conditions document and continues to be in those. And really this is what's been often referred to as the balanced billing prohibition. So we've highlighted some language in there, but really want to consider taking a look at this. Sometimes the folks I talk with have indicated, well, we didn't have any of these situations occur. But really thinking about that from an audit perspective, the question really would be, how can you demonstrate that you did not? And what was your processes in place to ensure that that did not happen? So thinking about those balanced billing considerations, wanted to call out that there is some language in there of using the presumptive or actual cases of COVID, and highlight that that's not the same as possible. We see the reference to possible in the Notice of Reporting Guidelines document and the FAQ document. So really want to think about that as presumptive has to do more on our billing side of the house, and the possible is going to have to do with on our quantifying expenses for the utilization of those funds. And just as a refresher, HRSA had said they consider every patient to be a possible COVID patient, which was some of those confusing components that came about in the beginning was, well, do we then, when we're quantifying expenses, do we can only look for COVID patients? Or, so HRSA clarified that your expenses related to preventing, preparing for, and responding to COVID could be for all patients, not just COVID patients. Like I mentioned, thinking about for the considerations on this balanced billing, consider whether updated policies and procedures or guideline documents or procedure documents that would take this into account. And what about monitoring that might be occurring? And this is oftentimes where I think we can pick the benefit of our compliance folks within our organization for help with monitoring potentially. So some strategies around this, and I would say if you've talked with your auditors as far as say a single audit or a program-related audit that Matt's going to talk about later, it's going to be looked at differently than originally thought, I think. But the thing to keep in mind is regardless of how it's looked at for single audit or just the general program audit, these funds are subject to audit by any federal body. And so we really have to be thinking more broadly than just getting through our single audit or this initial audits we might be going through. So I would say, if not yet, really look at implementing the process to make sure that you don't end up with a situation of a patient being billed in contrary to the terms and conditions component. And I'm a big fan of data analytics. I think there's a lot we can get from data. It can be hard to get it set up, but I think this could be a way that data could possibly be used to really help drive that and monitor that. And like we said, implement a monitoring process to look for that potentially in the future. And I would say, to some degree, this really could help bridge and span if we think about the more recent, say, No Surprises Act and some of that piece where there's very specific elements where patients cannot be billed under certain situations. I think these same principles of setting this up can be applied there. So it can have really good bang for your buck to set it up. This is an interesting document. So this is one of HRSA's documents and that they put together more recently that talks about non-compliance with the terms and conditions. And so like they say here, non-compliance with any component of the terms and conditions is really grounds for HRSA to seek repayment of those funds. So it's really important to keep those terms and conditions kind of at the forefront. I would keep them handy. I would look at them frequently. That's, I think, where the communication channels can be super helpful in your organization to keep abreast of that and make sure that somehow a non-compliance component doesn't come about. And like we know so often with healthcare funds, this too can be subject under certain circumstances to the False Claims Act, and that's kind of what this language in the second component really is kind of getting at, is that they can have some teeth if they the federal regulators do come in and they look depending on how things are. So just really important to keep those things in mind. Now, wanted to talk a little bit about kind of these period 2 considerations. And yes, we are here in the middle of March. And so as we know, for period 2, reporting is going to be due by March 31st. There's no indication right now from HRSA that there will be an extension to that like we saw with the period 1. So thinking about it, most folks probably just maybe by raise of hands, like, are you like have your stuff in the portal if you have period 2 related to you? Like, are you populated in the portal yet? Or, oh, lucky you. So anyways, think about that. The time period for this is, of course, funds received from July 1st of 2020 through December 31st. And then we had until December 31st of 2020. So you had a full year plus to use those funds. And then, like we mentioned, portal's currently open till March 31st, 11:59 p.m. Eastern Time. I would suggest, if you are reporting for period 2, really try and get that done, and not, a lot of folks were at the 11th hour, so to speak, with period 1. And didn't happen with the reporting, but for some folks for phase 4 application, they had a difficulty getting in, and it was toward the end of the time. So I would keep the Eastern time period top of the mind and try and get your report in well ahead of that. So is there anybody here who is going to be, period 2 will be the first time that they're going to be reporting on the funds? I won't belabor kind of the information here if this is not. But I would say if you do know somebody who is, we included some information of things to consider if this is a first time for reporting. Lots of links to information in the portal. But for anybody who this is their second time around, there was a technical assistance webinar, and it is a recording, and we've got the link here. It's really more of a mechanical components of doing the information and putting information in the portal, just as an FYI. I think like some of the other webinars HRSA did, it's very good on the technical side, but not so much about explanatory of certain situations. The portal is going to have pieces that will pre-populate. So as an example, the other assistance received is going to pre-populate, and it's just going to be those couple of quarters, the third and the fourth quarter, to add information. Your expenses will not pre-populate. There's going to be the full now 8 quarters to report on potentially. So thinking about that, one thing to keep in mind is be able to demonstrate that any dollar you're reporting for period 2 wasn't reported as part of period 1. That'll be super important for audit purposes later on. And then, of course, for anybody who might have had nursing home infection control payments, period 2 will be the first time you're reporting on those. So there will be screens populating that we did not see in period 1. There are a couple nuances to think about for period 2. Like I mentioned, some information will pre-populate and others will not. You can change contact information if need be for whom is going to be reporting. Like we mentioned, the duplication of reported expenses, really that's going to be on our underlying supporting documentation to demonstrate that that did not occur. And that would be not just of other sources of reimbursement, but also our prior period reporting as well. And the lost revenues, HRSA has said that, well, they had recommended in one of their guidance documents to going forward for period 2 and beyond would need to keep the same methodology for your lost revenues, but HRSA has now said you can change your methodology if you would like. However, you have to provide a statement as to why you might be changing, and it's going to recalculate your revenues all the way back. So it will possibly change period 1 revenues. So I would say if you are going to be changing your methodology, it would be really good to have a discussion with your auditors as well, because it hasn't really been, I don't think, fully bled out what that's going to look like. But if your period 1 numbers change, that could affect your audits for period 1. So some other special considerations, the rural health clinic distribution, there was payments originally back in May of 2020 that folks might have had captured in their period 1 reporting. There was also in July of 2021 another distribution that went out to folks. And those funds have completely different reporting requirements. We've included the links here, and so that some folks got a little, I wouldn't say tripped up, but when they went to go do their period 1 reporting, they realized that, oh, there was reporting I was supposed to have been doing for the rural health clinic. And that's one of those lines that will pre-populate for you on the other assistance tab in the portal. But some information if so, like we mentioned, there's also the HRSA COVID claims reimbursement and the coverage assistance fund as well. Those also have very specific components. So if you did partake of it, there's some information about it. If not, that's still available. So some information there if that is of interest to folks. Now I'm going to ask before I go on, did anybody have any nursing home infection control distributions that they received that you'll be reporting on? Because I won't use up too much time. But we've got some information here. Like I mentioned earlier, it does have very specific, more narrowly allowable expenses and expenditures, and we've got them listed here. The other thing to keep in mind is no lost revenue can be applied against those expenses. And also, interest earned, there's a separate, it needs to be calculated separately for any in nursing home infection control payments that were received. But honestly, most of the time, folks had the situation where their funds were pretty much fully utilized by the time they were received, so oftentimes there wasn't much of the interest that was calculated anyways for either this or the provider relief fund component. So some tips to think about. Other assistance received, that's in the portal. It's really for informational purposes. It does not feed to any other components. It doesn't figure into the calculation of utilization for the funds. And it is also to be net of other reimbursed sources. Some of the things that come up with this, because that's one of the key pieces, is HRSA has indicated other reimbursed sources. And oftentimes the question comes up about, well, I've applied for FEMA, but I haven't received any obligation information from FEMA or not. Should I include those expenses here? And HRSA doesn't have really clear guidance in this respect, but generally speaking, maybe consider those FEMA funds to be as if they were already obligated. Question does come up a lot from that. Like I mentioned, the rural health testing distribution, that should pre-populate if you did have any of that in that other assistance received tab in the portal. Some question that also comes up for folks thinking about the other assistance received is there's a line item that says other assistance on that tab, and some folks are thinking they should populate their provider relief funds amounts there, and really the intent for that other assistance line item is something that didn't fit with one of the others. So example, not any PPP, no state funding received, or other components, no business insurance. What is often a good thing there is if donations were received that were specific for COVID uses, that's a good line item there, or other random things that don't nicely fit. So think about that, and again, the other assistance received, it doesn't play into anything, so that also just wants to be the straight monies received. If you're keeping a tracking of all of that, that would be kind of those pieces that would go there. Thinking about the nursing home infection control, it is completely separate and distinct from the SNF distribution that was received as well, so a lot to keep track of all these distributions, and like I mentioned, you've probably noticed when monies are received for the provider relief funds, it doesn't say which, if it's phase 1, phase 2, phase 3, or some targeted, so can go back and kind of try and look at the dates when the funding streams were going on. Included here, just for some reference material, is some resources. I would say a couple of things. I don't know if you're already using it, but HRSA has published a reporting user guide, And they refreshed it a little bit for period 2 reporting, but it really has all, I don't know if you've been using it, but it has all the screens that you're going to see in the portal and some explanatory information. So that's been helpful for a lot of folks as they go through their reporting component. I would also say, probably not as applicable now, but there is a registration user guide as well, because as we know, trying to register the whole username thing, having to be an email, was very confusing for lots and lots of folks, and the username can't be duplicated. So some FAQs in there that can be helpful. I would also say monitor for their FAQ document. There is a PDF one can download of it, and generally what I do is I watch for that. I go back out to the website periodically because HRSA will make updates to it, and they'll put the last updated date in that document. So it's always good to keep the most recent document handy for any changes, but also it's really super important to have that for retention purposes if you were using any of the FAQs for part of your reporting package, because once they supersede it, you can't go back and get the old ones. So some of the FAQs just go away completely. Others get modified and some get added. So it's good to have that historical information. They also have a workbook that HRSA has created for folks you can download, and they refreshed it for period 2 a little bit. If you are using it, I think it's a helpful tool. Just keep in mind it doesn't have every screen you're going to see, so there is some information that you will have to populate from the workbook that isn't available in there. So I generally will add in my tabs and my little screenshots just to keep track of all the stuff that I'll be entering into the portal. Okay, so a couple strategies. So thinking about this and some of the risk that we might have with reporting can be super helpful. We have found to really develop kind of a master tracking document of sorts that kind of outlines all the different funding streams you've received. And I've seen folks have columns for the different streams and then rows of information about the expenses that are being kind of attributed to each one. It really helps set a viewpoint. It can also help demonstrate that you're not duplicating expenses across multiple streams. Like I mentioned, really downloading a copy of the guidance out there, because it does change and HRSA doesn't tell us when it changes. We just kind of happen to notice it when we go look. So keep a copy of it. If you do a snippet or a screenshot, I would say make sure you have the date captured in your screenshot so that you can later on go back and say, well, it was based on this date, because again, they just supersede information on their website. Our standard accounting processes and best practices really can come into play here as well. Like we mentioned, documentation is always a key thing. So keeping those receipts, management decisions about whatever it might be, whether it's the methodology for calculating, if there's board and committee meetings as well. Really important to have those in play. And keeping in mind, of course, the document retention to consider for these. The terms and conditions document says 3 years, but might consider a longer term just because we know other federal bodies can come in. As an example, OIG, the Office of Inspector General, had just put on their work plan recently that they're going to be auditing kind of that balanced billing component. They're going to start with hospitals. So that's on their radar. There's task forces and other groups who will be looking at this, and they cross-share information. So hard to tell. We know some folks have already been contacted by HRSA that they're also going to be audited for these funds in addition to their single audit. So just important to have that documentation at the ready. And then, of course, HRSA's got those published resources as well for folks. So again, the strategy for the balanced billing, look at that process now and see how you can leverage it as well for other recent federal legislation. And thinking about, like I said, the data analytics, I get all excited. I like data. And so several things had come to my mind that could be used to look at this, because like as an example, with some of the telehealth waivers that came about, that was a really good way to take a look and see. So I think there's ways to drill down, and I'm happy to chat about ideas if anybody's interested in looking into that. And then, of course, that monitoring process will be super important, I think, for watching for future pieces of it. Okay.
Thank you, Melaney. So I'll be covering the auditing considerations, and before we jump into the auditing aspect, you have to know the accounting for it first, right? So we got FASB and GASB, your two options for accounting, at least on this slide. The not-for-profit healthcare reporting entities, that's going to be topic 958-605. There's a technical Q&A that was issued. There's 4 paragraphs in there. Summarized it in 2 bullet points. So basically the contribution revenue is recognized with donor restrictions when the conditions are met. And then, you know, most of our organizations we audit, what ends up happening is because you're recognizing the revenue in the same period that matches the expense, there's a simultaneous release accounting policy option. So nerdy lingo, but basically you're recognizing the revenue unrestricted or without donor restrictions along with the expenditures. From the GASB perspective, that's under statement number 33. And what they're saying there is it's the reporting for the non-exchange transactions. And there's a technical bulletin that was issued 2020-01, the accounting and financial reporting issues related to the CARES Act and coronavirus diseases. And so they're recognizing the revenue as non-operating once the eligibility criteria is met. Quick summary, so the FASB, you can recognize the revenue as operating or non-operating. It's going to depend on your accounting policy election. And then on the GASB side, the only option is non-operating. From an accounting now going to the audit considerations, the not-for-profit entities, it's applicable starting with your June 30, 21 year ends or after. And if you have expenditures exceeding $750,000, you're subject to the federal single audit. Commercial entities or for-profit entities will be subject to single audit in conformance with the requirements of subpart F. That's the question. And so there actually are 2 options for the for-profit entities that expend over the $750,000 in awards. You can have a financial related audit of the awards or awards conducted in accordance with GAGIS or generally accepted government auditing standards. Or option 2, which is going back to what the not-for-profit option is the audit, single audit for the provider relief funds, general and targeted distributions. And that must be included in determining whether the audit is in accordance with subpart F. And the final note at the bottom, the audit reports of those commercial organizations, they must be submitted via email to HRSA at hrsaudits.gov. So from a single audit, program-specific audit, understanding the differences here. So there's a compliance supplement that's issued each year from the federal government. And in 2021, they issued some guidance specific to assistance listing number 93498, which is the provider relief funds. And the following deadlines are used for spending the funds. So if you had a year end that was June 30th, 21 until December 30th, 21, and that's not a typo, December 30th, those total expenditures and lost revenues from period 1 reporting will go on those financial statements. When you get to December 31, 21, all the way until June 29, 22, you're going to be recognizing the total expenditures and lost revenues from periods 1 and period 2. Finally, there's everything after June 30, 22, and that will be addressed in the 2022 compliance supplement. So the top part here is a snapshot of what the portal looks like and how the information is entered in there. There are 2 parts to consider here. Where single audits conducted for any of the fiscal years noted above, so you'll check the box if it applies. And then the provider relief fund payments included in those audits. So as very specific guidance came out that the 2019 and 2020 year ends, if there were single audits, they should not have included PRF, and those boxes should not be checked. Getting into the areas of testing, talking about the single audit, the main area is most likely going to end up being the allowable costs activities. Anyone that's done a federal single audit before, this is a common procedure we do on all of those type of audits. So specific to provider relief funds, the expenses must be used to prevent, prepare for, and respond to the coronavirus. Not being reimbursed from other sources or other sources, we're not obligated to reimburse them. And as Melaney mentioned earlier, specific allowable expenses have been identified for the skilled nursing infection control distributions. So what the other requirement is reporting. So you get the allowable costs testing done. Now you move on to the reporting. There are 3 key line items as part of that audit procedure. So the total nursing home infection control expenses, if applicable, other provider relief fund expenses, and then total revenues reported. And this is, you had 3 options when you submitted the filing on the portal: total actuals by quarter, totals by for budgeted amounts by quarter, and then finally there was an option for an alternative method. Just keep in mind, if you chose that method, those inputs, we'll have to audit them back to the narrative and any other underlying source supporting documentation. So this gets into the special tests and provisions aspect of the audit. Out-of-network patient out-of-pocket expenses for patients with a presumptive or actual case of COVID-19. From an auditor's perspective, we're gonna have to review the billing and collection policies and procedures related to that, and then actually test some of the out-of-network patients to determine whether the patient was assessed out-of-pocket charge for services and if the charge was in compliance with the terms and conditions. This is gonna be inherently challenging to audit. It's very difficult for a client to assert compliance with this contractual term. And so as a result, the GAQC is currently working on this issue, and we're hoping to get some more clarification. Moss Adams as a firm, we're kind of holding off on this test. We can start the provider relief fund audits, but this is one of those areas it's super hard to figure out. They use the terminology for a single audit directed material. It's really hard for us, based on the guidance that's in place, to really say whether it's directed material or not. So in general, we've been holding off on this provision for now. Compliance testing, so the guidance is still pending, but there's a link in the slide. The GAQC presentation was on January 20th, 2022. Highly recommend it. It went over the information listed in the slide, auditing for profit, entities receiving the provider relief funds and other HHS awards, information provided on the compliance testing options, examples provided, and perspectives shared. And then the next bullet point, there's a slight tweak to it. The practice aid was actually issued on February 25th, 2022. It is non-authoritative guidance, but nonetheless, it's good to read through it and just understand, what their thought process is and how you need to account for the information, ultimately how, the audit firm you work with is going to come in and look at the numbers. So this slide here is going through the audit options for the for-profit entities. There's the GAGAS financial audit. We'll call this the not publicly available financial option. And then on the right side, you have your single audit and program-specific audit. These are the types of reports that will be filed on the data collection form website. For those that have done a single audit before, your financial statements or program-specific audit become publicly available information. So a lot of our for-profit organizations we work with have been leaning towards going with the GAGAS specific audit solely for that reason. Just quick run through of the table, just the criteria difference. The program-specific audit can only be for one HHS program as opposed to multiple programs. The audit of the entity's financial statements is only required on the single audit. Presentation of the HHS schedule, it is a specific element, except for the single audit. There's a CFA that's attached to that, a schedule of expenditures of federal awards. The reporting on the schedule, the opinion will be on the schedule for all options. In addition, on the single audit, there will be an in relation opinion to the CFA with the financial statement opinion. The GAGAS reporting on internal controls over financial reporting, it's required in some degree for all 3 options. And then finally, the opinion on compliance and reporting on internal controls over compliance is not required on the GAGAS financial audit, which again, that's another reason our clients are choosing to go with that option. We don't have to form an opinion on internal controls, and that usually means less work for everyone. So the GAGAS audit, as I mentioned, has been the preference. Another thing to point out, some of our clients that receive the funds, they only do reviews or compilations during the year. So they've never been audited before, but they have to do some form of audit if they received over the $750,000 of provider relief funds. So the GAGAS audit, again, it's another option. We're just auditing the specific funds that were received and the relevant expenditures or lost revenues claimed, as opposed to a full-blown financial statement audit. This slide here is going over an example of what the GAGAS financial audit would look like. Again, if you've done a federal single audit before and you've prepared a CFA, this is going to look very familiar to you. The main difference that I notice when I'm looking at the slide is there's 2 columns for amounts recognized in accordance with GAAP in relation to what's being reported on the GAGAS financial audit schedule. So as noted before, Melaney was discussing, the periods are 18 months or longer, but the financial statements that you're recognizing the revenue, that criteria is met within the 12-month period in most cases. So in this example, there's a year-end, December 31, 2020, year-end December 31, 2021. You recognize the revenue in those specific years based on how the expenditures and lost revenues break down, but all of that, if this is period 2, because it's December 31, 2021, you'll be recognizing period 1 and period 2 provider relief funds. And then the last slide I had, just the compliance deadlines, the due date for all entities, including the for-profits. It's the standard requirement, the earlier 30 days after you issue or 9 months after the fiscal year end. So an entity with a December 31, 21 year end has a due date no later than September 30th. Even if you issued on September 15th, you still have that same September 30th deadline. And then for the year ends of June 30, 21 or earlier, the government granted a 6-month extension. And so hypothetically, an entity that is still not filed with a June 30, 21 year end has a due date no later than September 30, 22. Sarah, you'll cover some tax updates and considerations.
Testing. I don't have a lot of time to talk about taxes. It's complex. What am I gonna cover? Okay, this is gonna be a narrow conversation. I'm gonna talk about taxes that are relevant to that came about with the CARES Act, but are still relevant to talk about today. So I think I just want to acknowledge, first of all, that the CARES Act was a ginormous piece of legislation. And I think one challenge that taxpayers have had is just taking advantage of the opportunities that were in it and remaining compliant with all their different accounts. So I'm going to cover some kind of best practices or things to know as far as grant programs, payroll tax relief, a kind of a catch-all, other income tax matters, and then just have a few comments about where we're at with current tax reform. All right, grant programs. The 2 I'm going to touch on with you are provider relief funds, the topic of most of this discussion, and the PPP loans. I think most organizations have a pretty good handle on the accounting and the federal income tax implication of these 2 grant programs. The provider relief funds for a for-profit organization are generally going to be taxable at a federal income tax level, and the forgiven PPP loans are generally going to be tax exempt for a for-profit organization. My takeaway for this slide and my question to you is, have you analyzed and documented and considered the state and local business tax implications of these grant programs, because they can vary from the federal income tax considerations? So as an example, I put a link here to the Washington State Department of Revenue publication. I've referenced this a number of times myself. They call it Emergency Financial Assistance Grants. And so in this publication, the way that Washington defines emergency financial assistance grants, I think both provider relief funds and PPP loans would fall into their definition. And on this page, it talks about the tax-exempt status of those grants for purposes of B&O taxes. Now there can be taxability, perhaps at a California income tax level.
So anyway, the takeaway for this slide is to just be mindful that the state and local business taxes can vary from the federal implications. All right, payroll tax relief. I talked to you about the employee retention tax credits. I think this remains a significant cash flow opportunity for a lot of not-for-profit and for-profit organizations. So to be eligible, there's a two-step criteria, and I just want to highlight, I think a lot of healthcare providers are going to want to look closely at the second quarter of the year 2020 and the eligibility requirements for that quarter for the credit. I think a lot of healthcare organizations may be eligible to take advantage of the credit and haven't done so. So what is it? Stepping back, it's a payroll tax credit, and you claim it on your 941 filing. If you didn't claim it on the original filing, you can go and claim the credit by filing a 941X. And the payroll tax credit can offset certain taxes, and then any excess credit is refundable. So the IRS will send you a check in the mail. And I've seen small organizations get credits for $80,000 to $250,000, be very happy with that. And I've seen large organizations get, in my client base, I think $1 to $7 million. So cash flow opportunity provided by the CARES Act that remains relevant today. Also, just a nod to many healthcare organizations took advantage of the payroll tax deferrals. And I think that's something that what I've seen happening is 941 accounts, balances getting a little misaligned. So I've had some clients call some larger healthcare organizations and say, we're having difficulty, our 941 accounts, different quarters aren't quite aligned, or the deferral isn't appropriate, so we've had penalties assessed. And so calling the IRS and kind of resolving that issue has come up a couple times. But anyway, a takeaway for this is I just want you to have documented and just considered whether the employee retention tax credits do or do not apply to your organization. This is my catch-all slide. So the top one is relevant to hospitals that are Form 990 Schedule H filers. So on the topic of provider relief funds, I think for the 2021 reporting on your Schedule H, you're going to want to be really mindful about capturing COVID-19 expenses and COVID-19 programs that benefited your community and reporting that on your Schedule A as a community benefit cost. But when you do that, you have to be thoughtful about, well, what expenditures are aligned with grants? And do I need to be reporting provider relief funds, PPP loans, FEMA monies, as direct offsetting revenue to those COVID-19 expenses or programs that you provided to your community? And I mean, as an example, it could be education of the community, education of your staff, subsidized programs. The next item also came about with the CARES Act, net operating loss carryback claims. That's going to be relevant to a C corporation or a 990T filer who's for unrelated business income, which is essentially taxed like a C corporation. If you haven't assessed whether there's a net operating loss carryback claim, this is a cash flow opportunity to go claim a refund for taxes paid in a prior year. Next one, method changes, amended returns. This is going to be relevant to for-profit organizations. Again, this came about with the CARES Act. There's an opportunity, if you have significant leasehold improvement property, I mean depreciable fixed assets in your entity, that there might be an opportunity to do a retroactive write-off of those. And generally paying less tax today to defer it to the future is a good idea. Last note on this is, again, just acknowledging that we've seen in our client base just some struggles with delays with the IRS, or they're extremely backlogged right now, to the point of a little bit of frustration, I think, where it's hard to get through on the phone. They send you lots of notices, but they don't reply to your notices that you sent back to them. So just if you, well, one, you're not alone. And two, if you feel like you've really hit a roadblock, I just encourage you to talk to a CPA or a tax controversy specialist who can kind of help you navigate IRS procedures and get something towards resolution. Okay, CARES Act was big, so what is next? In my profession, we were all watching the Build Back Better Act very closely at the end of 2021. I think at this point it's lost traction. At the very least, they need to rebrand it. You know, the Biden administration made a lot of promises, and tax reform was a major component of their campaign. We heard a lot of things. Corporate tax rates are going to be raised. Wealthy individuals will pay more taxes. And none of that's come to fruition yet. I don't have a crystal ball, but the one thing I do know is that in 2025, there's going to be a lot of phase-outs and expiring tax provisions that are generally considered quite popular. And so I think, depending on the political willpower and the lobbying that happens from the business community and the associations, I expect that in the next 1 to 3 years, there's going to be incentive for Congress to actually make a move on tax reform. And who knows what the future will bring. But it'll be something, and it'll be complex. All right, so what do I want you to remember? Grant programs. Just assessing the state and local tax implications. Payroll tax relief, did you claim for Q2 2020 in particular, just assessing whether you're eligible. A couple of other matters, if you're a Schedule H reporter or a C corporation. And then what's next? I don't know. Well, that's it. Melaney, will you wrap us up? I think we got some wrap up.
Okay, so I wasn't checking what time. Was there any questions anybody had that we can answer? 5 minutes? Okay. One thing that I did want to mention, like I talk PR forever, but yes. That's a really good question. Yeah, absolutely. So she was asking about when we were talking about the balanced billing risk, and what if we did identify something? What's the real risk here? And I would say definitely proactively, if you do find something that did go awry, and someone was balance billed, really that the remediation efforts. Again, super important if you have a compliance department to have them involved, because it would be a matter of kind of following your normal procedure, because it would really be looking at, was that the only instance, how much more pervasive could it have been, and identifying and quantifying that and making sure that gets rectified. The last thing we want is our federal folks to come in and find it. I think that becomes a lot more challenging. So if we're thinking about the single audit as an example, and however that plays out, but like normally when we're looking in single audit world and we find something, we then have to extrapolate errors, as we might call it. So that could be a potential ramification if it comes about that way. So I would say, and I always get the saying wrong, but that saying of, you know, a good offense is a good defense, or whatever the case may be, but really proactively going and finding and looking for that, because it oftentimes it probably didn't happen very often if it did, but larger organizations it definitely could have, and you want to be able to demonstrate that you had a process in place to look for it. If you found it, have all that documentation in place of what you did to verify if it happened other instances, and what you did to correct that. Does that help answer your question? Okay. Any other questions? Okay, because one thing I was getting, yes.
Oh, wait for the mic to come.
Is that something that would be on, if it was a material weakness, if you found, a few of them or something that would be reported on the audit as federal and under a single audit reportable?
Yeah, so, and that's the other thing that's going to be weird how this plays out, and I can let Matt talk about this too, because I haven't done single audits for a while, but that's going to be the interesting thing, I think, as far as, like Matt mentioned, we're still waiting to see some additional guidance as far as what that's going to look like for the single audit. My understanding is it's not going to be on the 2022 compliance supplement. Is that part of, I think we were hearing that potentially. And so that's the hard part, because that falls under special test and provisions component. So that's a lot more pervasive as far as what's going to be considered, like Matt mentioned, directed material. And then if you find something and you extrapolate that, you've got the threshold that it becomes a material weakness if it hits that threshold. But I would be more alert to the other federal bodies, because like I mentioned, the Office of Inspector General has that on their work plan, and they are going to be looking specifically at that at hospitals. And depending on what is found, that could get expanded to other sorts of providers, but it is on the OIG's radar right now, so they are taking it really pretty seriously, I think, from that perspective. Any other questions? Okay, so one thing real quick I did want to mention is that option 2 on your reporting lost revenue of the budget to actual, that still has that same caveat that to use option 2, you'd have to have the budget established and approved for the entire period, so now 8 quarters, by March 27th of 2020. So for most of us, that's still completely off the table as far as an option. Oh, thank you, Sarah. Okay. And there's our contact information if there was any additional follow-up questions that we could help as you're going through these last couple of weeks, if you do have period 2 reporting, or when you get to the fun period 3 as well. It's not going to end. The other thing with that is, as we know, HRSA had put together, and we've got 4 periods that have been defined. For anybody who's receiving funds in 2022, HRSA is going to have to take into that account, because it's really not yet outlined as far as what your reporting components will be, but I imagine it will follow the same schedule. So I think we're all going to be in this for a little bit longer. Any other questions? Okay. Well, it's very nice to have a chance to come and share information today. So I thank you very much. I don't know if there's more announcements that need to be. Sorry, Christine.